Hello everyone, welcome to the Sure Short Topic series in which we are discussing the most important topics for your May 2025 exam cycle. And today we'll be discussing investment management, which is Unit 24 from your Module D, and definitely you'll see questions from this chapter. So make sure that you like the video, you share the video, and subscribe to the channel so that you do not miss any updates. Every video in this series is very important, so if you haven't watched the previous topics, make sure that you watch them as well. So let us start with what is investment management? Investment is an activity where we invest the money that we have saved. Investment means sacrificing the present consumption to get a return in the future. So we are using our savings in a manner that will generate returns for us in the future. Saving is income minus expenditure, part of our income that we do not spend on consumption presently. We are saving for the future. So rather than keeping that money in a safe wallet, what we can do, we can invest in various securities, real estate, gold, other entities, and earn a return in the future. This return can be an interest, dividend, if we are investing in a retirement plan, pensioners plan, or it can also generate tax benefits. So that is investment. Investment management is a professional service because as laymen we might not have the enough knowledge or enough time to manage our investment correctly so that we can generate the maximum returns. So, what we will do, we will approach a professional. So, investment management refers to the handling of financial assets and other investments by the professionals for their clients, and banks also provide the investment management services. Clients can either be individual or institutional investors, and investment management includes devising strategies, executing trades within a financial portfolio. Financial portfolio means there are various securities like equity shares, preference shares, debentures, other physical assets like gold, silver, where the individuals or the institutions they can invest their money. And when we refer to the elements of investment, so not only generating the maximum return, we also need to balance the risk here. And we need to give safety to our clients that their original principal on maturity will face no loss. Objective of the investment depends on the type of client, right? So that is investment management. Now, investment management involves deciding the investment goals, analysis of securities, construction of portfolio, evaluation and revision. This service is different from investment banking. Now, investment management is for those clients who already have surplus funds and they need to allocate them so as to generate profits. Investment banking, on the other hand, is for those clients who do not have surplus funds or they are in a situation of deficit and they want to raise funds. So, investment banking is where the financial institution serves the governments, corporations, and institutions by providing underwriting, mergers and acquisition, and advisory services. Through three services are provided under investment banking. Investment bankers, they provide capital raising for the companies if they want to start a new venture or a new subsidiary or a business, they'll be needing funds. That funds can be generated through the underwriting or capital raising. Mergers and acquisition, two firms want to merge together, an amalgamation, or one firm wants to acquire another firm, and advisory services. So, investment banks act as intermediaries between the investors who have money to invest and the corporations who require capital to grow and run their businesses. So, what they do, they act as intermediaries between the security issuers, who are the corporations who need capital. And on the other hand, we have the investors, And the investment bankers, they help the new firms to go public. They can buy either all the available shares at the price estimated, or they can buy a part of it. So there are types of investment banking services which are provided. There's all or none. There is the full sale, best efforts, firm commitment that we are going to see. This is investment banking. Now here we can say that it deals primarily with the creation of capital for other companies, underwriting new debt, mergers, acquisitions, reorganizations, managing the financial aspects of large projects. That is investment banking. All right, we can here see a pictorial representation. So there are investment banks acting as intermediaries in between of the firms and the institutions. Firms are on the sell side. The investors, investment banks, they buy the securities or the shares and they sell it to the institutions who are the investors. They are on the buy side. So bonds and shares reach through the investment banks from the corporates to the investors, and the investors, they pay and create capital for the corporates. This is investment banking, and this is how investment banking is different from investment management, right? So investment banking covers mergers and acquisition advisory and underwriting services. That is raising capital through selling stocks or bonds to the investors. So here are the services which are being offered by the full-time investment banks. Underwriting refers to capital raising and underwriting groups that work between investors and companies who want to raise money or go public via the initial public offering. This is known as new capital. Mergers where two firms, businesses, they want to merge together, they want to start afresh. Then sales and trading, matching up the buyers and the sellers of securities in the secondary market, where the traders, they themselves trade among themselves. Equity research, it is a research group of the securities that will help the investors make investment decisions. And asset management. All right, so these are all the services which are provided. Also, how the investment bankers will help the corporates by underwriting, there are three types. They can either provide firm commitment, where the underwriter agrees to buy the entire issue and assume full financial responsibility. Let's say the firm is raising 100 shares, the investment bank will purchase all of those shares and they will sell them further to the investors. If, let's say, out of those 100 shares, 10 are left unsold, then these shares will be kept by the underwriter or the investment banker. They will not return it. They will provide 100% commitment. Assume the full financial responsibility of any unsold shares. Best efforts refers to underwriter commits to sell as much of the issue as possible and return any unsold. So now out of these 100, the 10 that are left unsold will be returned back to the issuer without financial responsibility. So they will give their best efforts. They will try to sell off maximum shares. All or none refers to if the whole 100 shares are not sold, then the deal is called off and the issuing company receives nothing, either all or none. So if 10 are left, even the 90 will not be sold. Everything will be returned. So the deal is called off. These are the three types of underwriting services. Now, what is the organizational structure of the investment bank? We see there are various activities dealing directly with the investors. Then management of risk is another activity. Then supporting activities are also provided. So front office, middle office and back office. The investment banks are split up into three main offices. What is the role of front office? The revenue for an investment bank is generated by the front office. There's the investment banking, sales and trading, and research. These three primary divisions, they work in the front office. The institute will ask us in which of the offices of the organizational structure of the investment bank do we find the three divisions of investment banking, sales, trading, and research? So, in the front office, right? So, the responsibility of the sales and trading department is buying and selling of the products. Research department comes up with the various research reports on the firms or the industry, right? Then middle office works as a protector. The main function is to ensure that the investment bank doesn't engage in activities that are detrimental to the bank's health. They will ensure that the investment bank is not taking too much risk. So, functions like risk management, financial control, corporate treasury, strategy, and compliance, that is middle office. And finally, back office is the part that stays behind the curtain and provides supporting activities like operations, technology, so that the jobs that are needed by the front office to perform and make money for the investment bank, they can perform them with ease. So that is the back office. And this topic is very important. Definitely, in every cycle, the institute asks us questions. Then we have investment management versus investment banking. Investment managers, they help the clients reach their investment goals by managing the money that they already have. Clients can be individual investors as well as institutional investors, such as educational institutions, insurance companies, pension funds, retirement plans, and governments. And the investment managers, they work with equities, bonds, commodities, precious metals, etc. Right? So, what all activities are performed? Financial statement analysis, portfolio allocation, equity research, buy and sell recommendations, financial planning and advising, estate and retirement planning, as well as asset distribution. These are all the roles and responsibilities that the investment managers have. On the other hand, we have investment bankers which help the corporate finance needs, such as raising funds or capital. So, companies and governments hire investment bankers to facilitate complicated financial transactions like debt issuance, such as bond offering, new securities underwriting, mergers and acquisition, and IPOs. So, investment banking can involve equity and security research, making buy, sell, and hold recommendations. Investment banking firms also are known as the market makers. Market makers. Why? Because they provide liquidity or they connect the buyers and sellers to make the market. That is investment banking. I hope the difference between investment banking and investment management is clear. Next, we have these responsibilities that we have already discussed, the investment managers and investment banking. Now, what is portfolio management services? Actually, the three terms investment management, portfolio management, and asset management. These are the same. So, portfolio management is a tailor made professional service to cater the investment objectives of different investment classes. And mostly it provides solutions to cater the niche customer segment, the high net worth individuals. So, professional management of an entity's investments to create wealth. If the individual already owns individual securities, what they will get customized one-to-one services, management services. All right. So, tailor made, freedom, flexibility, these are all the advantages of the portfolio management. All right. So, there's asset allocation, diversification, rebalancing. How is portfolio management different from investment banking? I hope that is also clear. Portfolio management refers to the management of portfolio of assets, whereas investment banking refers to the various functions performed by the banker by offering different financial services, mainly dealing in the purchase and sale of stock, right? Also, portfolio management is different from mutual fund. What happens in a mutual fund? A pool is created, let's say if it is a equity mutual fund. So all the investors will know that they are putting their money into equity. Then the asset management company is going to invest the money pooled in into various equities, and then the dividends are shared as per the units. So how is portfolio management different from mutual fund? PMS offers higher degree of customization. It is one to one, whereas mutual fund offers customization to the extent of classification, whether it is a debt mutual fund, equity mutual fund, or a hybrid mutual fund. Engagement, there is more personalized engagement in the PMS as compared to the mutual fund. In the PMS, managers are directly accountable to the investors, whereas there is risk in the portfolio management. Fee structures, a fixed fee attributed to the mutual fund is there, but the PMS demands a share in the profit. Fee structure refers to the entry and exit as well as annual maintenance, that is expense ratio in a mutual fund. PMS, on the other hand, profit over a particular rate of return, so it is known as a hurdle rate, in addition to the annual maintenance fee. Asset ownership, investors retain the direct ownership of shares under the portfolio management. However, the mutual funds they offer units in the form of investment. And a very important point of difference, mutual fund attain any amount of capital, whereas portfolio management there is a minimum limit of rupees 50 lakhs. SEBI has said minimum you should have rupees 50 lakhs, only then you can go for the portfolio management services. This is also the biggest limitation of portfolio management. That is why only the high net worth individuals they can avail these services. Now, portfolio management services are also of three types, or rather four types. We have active portfolio management, which actively involves buying and selling. So there is active churning of the portfolio. So here the manager aims at beating the performance of a market index. We fix an index, we select an index like Nifty, and we will do what? We will try to outperform the index. So the active portfolio manager will take different positions than that of the tracking index. They will actively buy and sell securities to create more returns. However, for creating more returns, the strategy undertakes a higher level of risk. That is active. Actively, the portfolio manager is involved. Passive, on the other hand, where the manager aims to mimic the performance. Whatever the index is doing, we will do the same. We will copy it. We will invest in the same securities with the similar weights. This is known as indexing or index investing. So the churning is at its minimum. However, incurring the transaction cost leads to overall return being lower. So there is lower return and lower risk as compared to active portfolio where there are higher returns and higher risk. That is the difference between active and passive. Active outperforming the index, passive mimicking the index, copying the index. Then we have discretionary. Discretionary means the portfolio manager is given the complete control. The client will give the portfolio to the manager and say you can do whatever you want, right? The portfolio manager is free to adopt any strategy. This obviously demands higher involvement, also higher fees. And the best option is for those who have limited time and knowledge of investing. Opposite of it is the non-discretionary, where the manager will only suggest, they will only advise. The final decision will be taken by the investor themselves, the client. So the PMS will only suggest the investment ideas, while the investor will be responsible for choosing the recommendation and timing. So here the PMS is an advisory capacity, and the final call rests with the investor or the client instead of the portfolio manager. All right. So these are all the important concepts of investment management. which I will repeat is very important from your exam point of view. Definitely, you will see questions, more than 7 8 questions from this chapter. All right, so that is all for today. If you found this video helpful, make sure you like it, you share it. Don't forget to subscribe to the JIB CIB English Medium channel, because here you are going to get this series and much more, everything for your exam preparation. I will see you again with other topics. Till then, watch the other videos as well and comment down below if you have any doubts or queries. Thank you and all the best.